Hi, all. I think we'll get started now. So welcome to the presentation of our results from 2 studies on PrizeLinked incentives. I'm Michael Rosenbaum, and I'm a Senior Research Associate at Innovations for Poverty Action on the Financial Inclusion Program. Before we jump into the actual content, I want to let everyone know that there'll be time for a Q&A at the end of the webinar. To submit questions for the Q&A, there's a little Q&A box at the top of your screen, and if you type in any questions you have, we'll receive them. We'll answer as many questions as time allows at the end, so please send them our way. Otherwise, the webinar is going to be recorded, and it'll be accessible after the session's over. Today, we're joined by Jeremy Burke, Sean Higgins, and Rebecca Rouse. Jeremy Burke is a senior economist at the University of Southern California's Center for Economic and Social Research. Sean is an assistant professor of finance at the Kellogg School of Management and a postdoctoral fellow in household finance at the National Bureau of Economic Research. Also joining us is Rebecca Rouse, the director of the Financial Inclusion Program at IPA. IPA's Financial Inclusion Program partners with service providers, governments, and researchers to design and rigorously test financial services, products, and programs to encourage healthy financial behavior. To give you a brief overview of the schedule for today's presentation, before we dive into the studies, we'll give you a brief overview of IPA and RCTs, as well as provide some context for these studies. Then Jeremy will present the results of his study on a PrizeLinked debt repayment program, and Sean will present the results of his studies on a PrizeLinked savings program. Rebecca will then discuss how these results provide insights on financial product design with Jeremy and Sean. Finally, we'll end with a short Q&A session. I'm very excited about this, but first things, we'd like to thank the Ford Foundation for their generous support. The Ford Foundation's support has made one of the studies that we will present today possible, as well as this webinar. The research is part of a broader effort by the Ford Foundation in partnership with IPA to design and test behaviorally informed products with academics and practitioners in the United States. Jeremy's study is one of the rigorous evaluations that resulted from the Financial Products Innovation Fund, and we're really excited to present the results. I'm sure many of you are familiar with IPA, but as a quick overview, IPA is a research and policy nonprofit that discovers and promotes effective solutions to global poverty problems. Since our founding in 2002, IPA has conducted over 800 studies with 600 academics and in 51 countries. This research has informed hundreds of successful programs that now impact millions of people worldwide. IPA's work is around 3 distinct pillars: creating strong evidence, sharing this evidence strategically, and equipping decision makers to use this evidence. Our approach works in those pillars, and we design these solutions with academics, evaluate them, and incorporate the process into programs and policies, all the while engaging and championing the use of evidence. To do this, IPA uses randomized control trials, or RCTs, to measure impact. They provide the most credible and reliable way of learning what works and what does not. RCTs rely on the random assignment of a program or policy to measure its impact on those that receive the program compared to those who did not. Any change that we observe between the 2 groups can be attributed entirely to the program and intervention itself, rather than other external factors. The evidence presented today comes from 2 RCTs. As I'm sure you're all aware, a lot of the motivating problems around IPA's work is that there are low savings, at least in the financial inclusion space. There are low savings and high debt levels for many consumers across the world. There is substantial common ground between developing economies and developed economies, especially the US, around the need for credit and savings products to smooth income volatility and other shocks to household finance. With some careful analysis, evidence from intervention in the developing world could be applied to expand our understanding on how to encourage the use of safe consumer credit and large and savings balances. Likewise, challenges around consumer debt in the US can provide learning opportunities for many developing economies with increasing levels of financial inclusion. In both of these contexts, proactive work among financial service providers and regulators is necessary to ensure that consumers are able to accomplish their goals and make financially healthy choices, even when acquired behaviors may stand in the way of these objectives. As I'm sure everyone in this audience knows, humans tend to be irrational, and this creates many of the financial, or at least flows into many of the financial problems that we have. A lot of suboptimal financial decisions can be explained by thinking about behavioral biases. This slide has a few examples of behavioral biases that we experience, but this is something a bit more intuitive that we all experience on a day-to-day level. One good illustration of this is imagine that you have a choice between receiving $80 now or $100 a year from now. What's your choice? Most people generally choose to receive $80 now rather than wait for another year. Now, imagine that that choice is $80 10 years from now or $100 11 years out. What's your choice? Has it changed? Most people do switch, even though that option is basically the same. $20 more if you wait an additional year. In the near period, where the choice is between today and a year from now, people prefer a smaller immediate payoff over a larger delayed payoff. However, when the other option is presented between the 2 points in time many years out, people are more inclined to wait an extra year to get the larger payoff. There is something about the remoteness that affects the decision-making process. We have a present bias and really only discount appropriately when we're not thinking in terms of the present. Financial products can be a solution to some of these behavioral biases. They can take the form of structural modifications such as default enrollment. Default enrollment is a really good example since there's a rich literature on automatic enrollment and how that can create and encourage positive financial behavior. This happens if you think about retirement accounts. Automatic enrollment into retirement accounts has rich literature describing increases in participation and savings. Other types of modifications are less well studied, and that's partly why we're here today. And because they may have the similar potential to support customers and consumers as they accomplish longer term financial goals. As we think about these designs, incentives especially, it can be helpful to think about present bias as just one example. If a financial service provider knew that consumers were biased towards decisions that help their present self more than their future self, actual uptake of a savings product may underestimate what consumers really want a year from now. A savings account could be designed to combat that impulse for consumers to help them accomplish their financial goals. Maybe by offering a monetary incentive to encourage uptake. This is a broader category of what PrizeLinked financial products do. So now we're going to present some of the evidence on these PrizeLinked products. This is the first rigorous evidence on PrizeLinked products. So hopefully this provides some insights for you. I'm gonna first pass it off to Jeremy Burke, who will discuss his study on a PrizeLinked product aimed to reduce debt. And then Sean Higgins will present his study on the effect of a PrizeLinked product aimed to increase savings. I'll now hand it off to Jeremy.
Okay, thanks. Share my screen here. Well, thanks very much, Michael, for that introduction, and thanks to everyone that took time to join this webinar today. And the study I'm going to talk about is going to investigate whether PrizeLinked incentives can be effective in improving consumer financial health, particularly whether they can help consumers reduce high-interest debt burdens. So the idea to use lottery-linked or prize-linked incentives to try to improve financial behavior is not new. This has been around for many years, though almost invariably this has come in the form of PrizeLinked Savings, where we're trying to make savings more attractive and fun by turning deposits into entries in the lottery. I think Sean will talk a little bit more about how this works, particularly in the savings context. But programs featuring these incentives have been popular internationally for many years. So one example is the UK's Premium Bonds program, which is over 50 years old. Around 40% of the British public participates, and collectively they save more than £25 billion in these accounts. These programs have been much slower to catch on in the US context, due in no small part to the fact that they used to be illegal, although that's recently changed, and the first large-scale demonstration project was launched by Commonwealth across credit unions in Michigan in 2009. And since then, there's been a proliferation of legislation across the country allowing financial institutions to offer these programs featuring these incentives to their clients. And so any initiatives or efforts to try to help consumers build savings balances are noble and worthwhile, since we tend to struggle in this area. But a challenge is that for many consumers, it's not so much a lack of savings that's the main threat to their long-term financial health. It's that they're carrying around large, high-interest, unsecured debt burdens. So outstanding unsecured debt now exceeds $1 trillion in the US. The bulk of this is credit card debt, and the problem is particularly pernicious at the lower end of the economic distribution, where households that hold unsecured debt tend to hold about twice as much as their annual income in the bottom income quintile. So the interest rates to carry debt like these can just be crippling. So it's not uncommon to pay 15 to 20% APR on credit card debt. Those with less than stellar credit might face APRs to be 20 to 30% on personal loans. And the implied interest rate on a standard payday loan, where you pay $15 to borrow $100 for 2 weeks, is 390% APR. Okay, so for consumers carrying debt burdens like these, it's likely more financially advantageous for them to place their marginal dollar towards debt reduction rather than build up savings, even if that savings is in a PrizeLinked account. So here's an area where we really want to try to help consumers improve their financial behavior. So there's a variety of reasons why we might expect PrizeLinked incentives to help or be effective in motivating consumers to improve their financial behavior, either by building savings or reducing debt. First, we know from a lot of previous research that people tend to overweight small probability events, and they have disproportionately large impacts on their behavior. So when a behavior is linked to a potential life-changing monetary amount, this can be highly motivating and nudge people to increase behavior or take more actions along this dimension to try to achieve this large discrete outcome. Also, they might help combat present bias. So as Michael walked you through these incentives for this bias at the outset, when we're asking people to build savings or pay down debt, essentially we're asking people to sacrifice consumption in the immediate term in exchange for improved financial health sometime in the future. And present bias works directly against us in this context. At the basis level, it might be that introducing these incentives can increase simply the excitement of engaging in this behavior by introducing gambling and attract people to either building savings or reducing debt by introducing the chance that they may win prizes when they take these actions. Alternatively, it may be the case that any evidence we see in a correlational setting might be driven by selection, such that people who are going to engage in these behaviors, paying down debt or building savings anyway, are the same ones who elect to participate in programs featuring these incentives. So we have a little bit of evidence on the efficacy of PrizeLinked Savings from previous studies. So some observational or non-randomized studies find that consumers tend to be attracted to these types of incentives and are willing to open accounts that feature them. Some evidence from the lab suggests that in very controlled settings, consumers find these incentives to be motivating and may change their behavior accordingly. But there's very little evidence from randomized controlled trials in the field. The only other one that I'm aware of is Sean's paper, we'll talk about that in a second, so I'm not going to walk you through there. But we have no large randomized controlled trial evidence in the US context, no evidence from randomized controlled trials that randomize the incentives at an individual level, which allows for careful decomposition of causal behavioral change or treatment effects as compared to selection effects or effects where consumers are self-sorting into the incentives such that consumers would engage in the behavior anyway are the ones who take them up. And no evidence, causal or correlational, that I'm aware of whether or not these incentives might help consumers reduce high debt burdens. That's what we're going to look at in this study. We're going to conduct a large-scale RCT examining whether pricing incentives can be effective in helping consumers reduce their high interest debt burdens. And particularly, we're going to examine whether the introduction of these incentives helps reduce delinquencies and defaults, helps consumers improve or increase the amount of overall debt reduced, and whether they can be offered in a financially sustainable method for providers such that the costs associated with delinquencies and defaults are reduced in excess of the amount of prizes to be awarded, and we'll randomize the incentives at an individual level and carefully look at whether any associated effects among consumers participating in the program are driven by causal behavioral change or whether it's driven by selection, namely people taking up the incentives who would engage in this behavior. To do this, with thanks to Ford Foundation for providing the financial support to conduct this study and research assistance from Innovations for Poverty Action, we partnered with Money Management International, which is the largest nonprofit full-service credit counseling agency in the US. And we're going to institute our PrizeLinked Incentive program into their debt management plan. So for those not familiar with the debt management plan, this is a structured debt repayment program in which MMI goes through a painstaking process with their clients to figure out the nuts and bolts of their entire financial life and then come up with an affordable repayment plan such that they can get out of debt in 3 to 5 years. Then they introduce a one monthly payment system where clients make payments directly to MMI, and MMI disperses it to the client's creditors and according to the renegotiated agreements. MMI also intercedes on their client's behalf to reduce interest rates and late fees and bring accounts to current status if they were in delinquent status on clients' credit reports. So despite the benefits and the costly process in terms of going through and setting up one of these programs, about a quarter of people don't make it through the first year, and only about 1 out of 3 successfully complete the program and get out of debt. So we're going to see if we can improve upon this a bit through the introduction of behaviorally informed incentives. And the way we did that is with a program we called the Every Payment Counts Reward Program. And specifically, this is going to turn debt repayments into entries in a lottery. So each time the consumer in the program makes an on-time in full debt repayment, they're going to be entered into a monthly lottery to have $500 knocked off the balance of their existing DMP. And each monthly on-time payment also grants clients entry into the grand prize, which is $10,000 knocked off the balance of their outstanding debt, which at the median would make a borrower in this program debt-free. So fairly high-powered incentives from that perspective. And we ran 12 monthly lotteries through the calendar year of 2016, and then drew the grand prize at the end of 2016 based on consumer repayment behavior. So we have a fairly nice sample with which to estimate effects. And we're also interested in where in the debt repayment life cycle these incentives might be most effective. So we stratified our randomization across 3 different groups, namely those who were just new to the program and just starting out the debt repayment life cycle, those who are 1 year into the program, and those who are about 2 years into the program. Our hypothesis was that consumers who were just starting out repaying their debt may be more amenable to these incentives and may help them make the behavioral change required to be successful within the context of the program. But we also wanted to see whether those closer to the finish line might need a little boost to get over the line and get out of debt entirely. So we have some pretty great administrative data that we can use to really figure out what the effects of offering these incentives are in the debt context. Namely, we're going to have credit report information that we pulled at baseline, so before we started the program. And then we have another pull right at the end of the 1 year mark, so right after the end of the incentive period, and then another credit pull a year after that, so 2 years after the start of the study, to examine whether any effects we observed within the context of the period in which the incentives are active persist after those incentives are removed. We have monthly administrative data from MMI, tracking repayment behavior, delinquencies and defaults, and then a bunch of information on responses to our marketing efforts, which I'll talk about in a second. So apologies for this slide with many, many numbers, but I'll try to walk you through what I think are important here. So here we're just looking at the characteristics of who it is that are in the study, which is broadly representative of consumers and a debt management plan as a whole. So the average balance starting on the debt management plan is about $15,000, with the vast majority of this being credit card debt. Most consumers have between about 3 and 4 years remaining on their DMP at the start of the study, and they're making payments of about $475 a month, which is about 18 to 20% of their monthly take-home pay. So fairly sizable commitments to getting out of debt, which is pretty onerous month over month. So average age in our sample is about 48 years old, about 2.5 dependents. About 18% of borrowers have a co-client, typically their spouse, on the DMP. About 2/3 of our sample are females, and about 63% are white. As you saw in the previous slide, the bulk of our sample are new starts. 58% started in 2016. And for the researchers in the audience, all these observable characteristics are balanced across treatment and control. So this is going to help us really isolate the effects of the incentives themselves, given that the two groups are very observably similar before the introduction of the incentives. All right, so a threat to the study in this context is if the consumers don't know or are unaware of the existence of these incentives. So we went with a 3-pronged approach to try to advertise their existence, get consumers interested about them, and get them to sign up for the program. So namely, first we ran an email campaign in which we sent clients an initial email describing the existence of the program and basic information on how it works. And if they didn't respond to the first email, they were sent another email a couple days later. If we didn't receive a response to either of our emails, then consumers were kicked into an auto dialer campaign in which we had an MMI support counselor pre-record an audio script of the existence of the program and how it works. And then consumers could press 1 at the end of the audio recording to opt in, press 2 to opt out, or press 3 to talk to support counselor. And if we didn't connect at all with any of our auto dialer campaign initiatives, then consumers were kicked into a direct outreach program where support counselors would attempt to reach them via phone, either at home or at work. So here is an example of the first email that consumers were sent, where we're saliently highlighting the grand prize amount, describing why MMI is offering this program and how it works, describing the structural incentives, what consumers need to do in order to win, excuse me. And then to make it as easy as possible to enroll, consumers are able to click yes directly within the body of the email, say this is something I'd like to participate in, or they could click no thanks, I'm not interested. If consumers clicked yes, we gave them a little pat on the back, and this image is a good visual representation of how I felt every time someone agreed to participate. And then a reminder of what they need to do each month, essentially just pay on time and in full, and they're automatically entered into these sweepstakes at a monthly level and at the grand prize level. If consumers clicked no, we registered our shock and dismay, again described the program and gave them one more opportunity to sign up. Although in practice, almost no one saw this web page. Essentially, they either clicked yes, they want to participate, or they ignored our emails. If they ignored our emails, they heard this pre-recorded script through an auto-dialer campaign, which contains very, very similar information, essentially the same information contained in the body of the email. And then again, to make it as easy as possible to sign up, consumers could press 1 to opt in, 2 to opt out, or 3 to talk to a support counselor to ask more questions at the end of the auto-dialer campaign script. And as I mentioned before, if neither of the two prongs of our 3-pronged enrollment strategy made a connection, then consumers would call clients at home and at work, on weekends and off hours, or at work during business hours. And lastly, in order to keep awareness and interest in the program as high as possible, we would send out monthly reminders about the existence of the program and also highlight the previous month's winner, where we tried to elicit a quote and a picture and introduce that into the body of the reminder email to show people that, hey, this program, people are winning and things are going well for them. And then if people hadn't already signed up, they had another chance to sign up in the context of the body of the reminder emails. All right, so what happened? So we found some pretty robust evidence that consumers were interested in this program. About 3/4 of the treatment group, so those who are eligible to participate, took up the incentives, where only about 6% actively opted out of the program, okay, and told us, no, this is not something I want to participate in. And the remaining 20% didn't respond one way or another to our marketing efforts. So before moving to the causal behavioral change that we saw from the program, I first want to show you selection effects, or namely correlational effects, essentially what we would find if we simply compared program participants to program non-participants without the benefit of a randomized design. So first, this chart is showing the fraction of clients that paid on time in full, conditional on remaining in the program. And the effects are small, they're a bit hard to see, but are statistically significant in the first 12 months when the incentives were active, that those participating in the program were about 1.3 percentage points more likely to pay on time and in full. And this effect completely disappears after the incentives are removed. But we see much larger differences among clients who remained in the DMP, namely participants who elected to participate in the PrizeLinked incentive program were much, much more likely to stay in the debt management plan and continue making payments over time. And then this translates into large differences between people who participated and people who do not in terms of total amount of debt reduced. So at about the 12-month mark, people participating in the program paid off about $1,000 more of their debt than people who did not participate. And this compounds over time and reaches about $2,000 difference between program takers and program non-takers at the end of our observational window, which is 2 years after the onset of the study. So we also saw some large differences on their credit reports in terms of overall debt health. Those who elected to participate in the program had fewer late payments on their credit report, fewer charge-offs, although we don't see much of a difference in the credit score, which is not surprising given that all of these consumers' credit scores are pretty depressed while they're on a debt management plan. Okay, so everything I've shown you so far in no way decomposes selection and treatment effects. We were just comparing those who chose to participate versus those who chose not to take up the incentives. But now we can leverage our randomized controlled trial to really see how much of this effect is due to causal behavioral change and how much of it is due to selection. Namely, maybe it's people that would pay off their debt anyway that are electing to participate in the incentives. And essentially you find that it's all the latter. Essentially there's no difference at all between the treatment and control groups in their proclivities to pay on time and in full. Absolutely no difference in terms of the fraction of clients who remain active in their debt management plan, and very well or precisely estimated 0 effects on total debt balance. Okay, so when we look at effects across the treatment group compared to the control group, we find that consumers in both groups were exactly as successful in terms of paying off debt. So there was absolutely no causal behavioral change, and all the effects came from selection. Namely, consumers who are going to pay their debts anyway were the ones who elected to participate in the program. And similarly, we don't find any effects on credit report outcomes either. Namely, there's no difference in late payments, charge-offs, credit score, or total overall debt, which suggests that these incentives didn't have any behavioral change effects on consumers in the program. I mentioned earlier we were interested in different effects across people at different points in the debt repayment life cycle. We find mostly no differences across cohorts, although there is evidence that those in the 2014 cohort, namely those closest to finishing the program, were actually less likely to complete the program when the incentives were active. Seems they wanted to stick around a little bit longer to see if they could win a prize, which actually had a negative expected value, namely the monthly fees they were paying to stay in the program were well in excess of the expected value of winning a prize. So to the extent that these incentives introduce any behavioral change at all, it seemed to be on an account, keeping an account open dimension, which maybe ties in a bit with Sean's study, which we'll talk about in a second. But here, keeping an account open was actually negative in the sense that they're paying more money to keep this account open than they would expect to be able to receive through winning a prize. So to sum up what we find in the context of this study, we find that similar to some observational studies we've seen on PrizeLinked Savings previously, that there's a lot of consumer interest in these types of incentives and the positive correlational effects, namely that takers, people that opt into the program, are more timely with debt repayment. They're less likely to drop out of the debt repayment program. They pay off more of their debt and experience positive outcomes on their credit report, but that these correlational effects are driven entirely by selection. Namely, you observe that there's no causal behavioral change in the context of this program coming from the introduction of the incentives. So what's going on here is that consumers who are more likely to repay their debt anyway are the ones who appear to be taking up these incentives. So this is evidence that in some cases, at least, pricing incentives may not modify behavior and may simply reward individuals who are going to engage in this behavior anyway. So not very cost effective in terms of trying to improve consumer financial behavior. So with that, I'll say thanks everyone for joining this webinar, and thanks to IPA for hosting it. And we'll turn it over to Sean.
Thanks for having me for this webinar. I'm going to present on long-term effects of temporary incentives to save, evidence from a PrizeLinked Savings field experiment. And this is joint work with Paul Gertler at UC Berkeley, with Aisling Scott, who's now at Facebook, and with Enrique Seda at ETOM. So the motivation for this study is that many people don't save much. And we know from a number of studies, a lot of RCTs, that there are many positive impacts of using formal savings accounts. These include an increased ability to cope with shocks, increased investment in small businesses, increased investment in children's education, and a number of other positive outcomes. But despite these benefits, the uptake and active use of formal savings devices remain puzzlingly low. And that occurs even when the accounts are offered without any sort of fees and without minimum balance requirements. We see, for example, in the US that 40% of Americans report that they either could not pay or would have to borrow or sell something in order to finance a $400 emergency. And worldwide, we know from the Global Findex surveys that 39% of adults lack a formal bank or mobile money account. So uptake of these formal bank accounts is low, as well as use of those bank accounts once people open them. So a potential solution to these issues is to offer PrizeLinked Savings. And the way that a PrizeLinked Savings account works is that you raffle off cash prizes every period of time. So for example, every month. And the number of tickets that someone gets for the raffle is a function of how much they save. And so the key of this product design is that the raffling off of these cash prizes incentivizes you to open the account. If, for example, you might have been procrastinating opening an account, all of a sudden now you have a bigger incentive to open the account if you value the small probability of winning a large prize in the raffle. But it also gives you an incentive to save in the account once you open it. So a lot of the previous studies we had seen either give you an incentive to open an account, or they give you existing customers an incentive to save an account. But here we have a product that both is incentivizing people to open an account, and then once they open them, again, thinking about all those other studies where we saw people open accounts but then not really use them, this product then gives them an incentive to save in the account once they open it. So here are a couple examples from different contexts. On the left, you see an example from the US, where we see an article in CNN Money about banks awarding lottery prizes for savings accounts. And this has been rolled out by, for example, credit unions now in a number of states. And on the right, we see a sign from our study, which was in Mexico, where we're working with a bank in Mexico and offering these PrizeLinked savings accounts. The reason these might work is that people may overvalue a small chance of winning big. And if they do, then this incentive through the PrizeLinked savings could nudge them to open an account and then to save in the account once they opened it, whereas the equivalent value in just paying them an interest rate, like a normal savings account would, might not be enough if they overvalue that small chance of winning the lottery. These have been successful around the world. As Jeremy mentioned, they started long ago in the UK. We've seen examples of them well throughout Latin America, the Middle East, Europe, and South Africa. And they were legalized in the US by the American Savings and Promotion Act in 2014. Prior to that, they were not legal. Now they are at the national level, but they still must be legalized by states. And so in some states, it's legal to offer these types of PrizeLinked savings accounts. In others, the state prefers to keep a monopoly on lotteries, and so they haven't legalized these. But as an example, Texas implemented a state constitutional amendment in November 2017 that allowed banks and credit unions to offer PrizeLinked savings accounts. So let me walk you through the context and the context of this study and the details of the experiment itself. The main question that we're after is, do PrizeLinked savings accounts lead people to open accounts and to save in those accounts? So to answer this question, we conducted an experiment across 110 bank branches in 19 states in Mexico. This experiment was in partnership with the bank Bansefi, which is a government social bank that has branches in areas with low financial inclusion. So this is a bank that was created by the government in order to increase financial inclusion. They located their branches in areas where they felt financial inclusion was low. So they had about 500 branches at the time of our study, and they still have about 500 branches today. We conducted the study only among 110 branches, and the way that we filtered those 500 branches to the 110 branches that would be part of our sample for the study that we would then assign to a treatment and control group is that we filtered out the largest branches because we were worried about those being unrepresentative of the kind of standard type of branch of Bansefi. We also did some geographic filters to avoid having geographic spillovers. For example, if a treatment and control branch were too close together, we would worry about spillovers. And once we did that filtering, we had our 110 branches. Then we randomly assigned 40 of those branches to treatment, in which we offer a PrizeLinked savings product to anyone who wants to open one in that branch. And we assigned the other 70 branches to control. Now, a key feature of this PrizeLinked savings experiment was that both new accounts, so if you walked into a treatment branch and opened an account, that would be eligible for the PrizeLinked savings lotteries, but also pre-existing accounts in those branches were also eligible for the lotteries. So if you had an account, you didn't have to do anything special. You could just start saving in the account, and your new savings that you developed since the start of this program, for example, the savings you added to your account over that next month would be eligible for these lottery tickets. And the way that they announced this product was through both posters in the branches, like the one that I showed you before, as well as loudspeaker cars in the surrounding neighborhoods, which is a common way to advertise various things in Mexico. The experimental design that we followed, as I mentioned before, was that we started with these almost 500 branches. We filtered them down to 110 branches, and then we randomly assigned those to treatment and control. You can see in this map that this random assignment and before that, the filtering process led to branches all over Mexico. So this was a large-scale experiment with a large geographic breadth. And you can see that we have treatment and control branches dotted all over the country. The timeline for the experiment was that in 2010, we started in September with announcing the lotteries. The first lottery was going to take place on October 12th, 2010. That was announced. And the second lottery on November 12th, 2010. So when we made the announcements in mid-September, the announcements included what dates the lotteries would occur on, and the signs that you saw an example of in the branch also had those lottery dates. And the way it worked was that every 50 pesos, or about $4 that you save by October 12th in the account, makes you eligible for one ticket. And those are new savings. So if you were a pre-existing account holder, your existing savings were not eligible for extra tickets, but your new savings each earned you a ticket. Then once you have those tickets at the end of the month on October 12th, they do the lottery. They lottery off 2 large prizes, which were worth about 10,000 pesos or $800, as well as 1,000 small prizes, which were worth about 400 pesos or $32. And the data that we have span the period leading up to the lottery. So we have data on account openings at each branch in the 6 months up until we announced the lotteries in September 2010. And we have data on new account openings during the 2 months of the lotteries, as well as the following 6 months. We also have transactions data for both the accounts that were opened during the lottery months, as well as any existing accounts beforehand and accounts that were opened in these months following the lottery. And we have those transactions data for nearly 5 years, going up through July 2015. So now let me move into the results of the study. First, I want to show you just some broad results at the bank branch level. So remember, we randomized this not among individual customers, but at different bank branches. And so from the bank's perspective, they're thinking about how much did this increase the number of accounts opened at the branches where we offered the product? How much did it increase the total deposits at the branches where we offered the product? The total number of deposits, as well as savings. So starting with the number of accounts opened, these are very small branches. I should have paused 1 second longer on this picture. This shows one of the example branches. You can see that it's a small branch. It has a couple of windows inside of the branch, but they don't serve a ton of customers at each particular branch. So the number of accounts that get opened each month is not particularly high. On the average month at the average branch, there are 3.3 accounts being opened. This led to, and so that's the orange bar here for the control branches. This offering the PrizeLinked Savings product led to an increase of an additional 1.1 branches on average in the treatment branches, or about a 33% increase in the number of accounts opened due to offering the lottery. That's averaging over both the lottery months and the following months where we have additional data on account openings. Next, I look at the effect on the number of deposits. Here we see, this is again aggregated within each branch. And here we see about a 14% increase in the number of deposits made at branches, again, averaging over both the lottery months and all of the future months we have going until 2015. And then finally, we look at total amount of savings or deposits held at the branch, which is both what we care about in terms of people thinking about increasing their savings, as well as what the bank cares about when they're thinking about, is this a profitable product for them to offer? And here we see about a 14% increase in the branch level savings. Now I want to take some time to go into a little more detail about each of these results and show you some additional results about both account openings, the number of deposits, and total savings at each branch. So on the account openings, we can break down that average I showed you before, which is averaging across the lottery months and later months, and we can look at it at the month-by-month level. So what this graph is showing you, on the vertical axis, we have the number of new accounts opened per branch. And each of these dots shows you what Michael showed in the initial presentation as the difference between treatment and control. Here we've just subtracted off the control. So each of these is going to be the increase in the effect of being a treatment branch on the number of account openings. Now, prior to the lottery, which is highlighted in purple or blue here, we see that there was no statistically significant effect. So we can't distinguish the difference between account openings at treatment branches and account openings at control branches from there being no difference. And that's as we would expect, because this was randomized, and prior to the lotteries, no one knew that there were going to be lotteries at these branches, so there's no reason to see higher adoption at the treatment branches than the control branches. Now we can look at the first month of the lottery. So this is going from September 12th to October 12th, so the month leading up to the first lottery. Here we see that the difference does increase a little bit, but we still can't distinguish it statistically from being 0. It's really only in that second month of the lottery, between October 12th and November 12th, where we see this statistically significant increase in account openings at treatment branches. And again, because these branches are very small, this effect is actually a 68% increase in the number of accounts opened at treatment branches relative to control. Then after the lotteries end, we see that there is not really any difference any longer between treatment and control branches, which again is as we would expect. We only offered these lotteries for 2 months and then we took them away. And we announced at the beginning we were going to take them away because we wanted to see whether this temporary effect could lead to a persistent effect on savings behavior, despite it only being a temporary incentive. And what we see is that, okay, these additional accounts got opened during the treatment months. In the following months, once the incentive was taken away, we don't see any more kind of residual effect of people going and opening accounts at these treatment branches. We can also look at that in even more fine-grained detail. So here I'm zooming in a little further, and instead of looking at month by month, I'm now looking at the effect each day. And so each of the dots in this graph are showing you the difference in the average number of accounts opened in treatment branches versus the average number of accounts opened in control branches in a particular day. Now, these are, again, small branches, and we're looking at just a day, which is a short period of time, so these are noisy. They bounce all around on the graph, but we can look at the overall trend to see what's happening in terms of adoption, and that's what the blue line here shows you. And what we can see is that, again, before the lotteries were announced, we see no difference on average between account openings at treatment and control branches, which is as we would expect. Once we announce the lotteries, we start to see an effect increasing here. So it's increasing over time over those 2 months of the lotteries. And then immediately after the second lottery ended, now there are no more lotteries, and we see the effect drop back down to 0. So right after that second lottery, the incentive goes away, and now we don't see any new people coming in to open more accounts at the treatment branches than at the control branches. But also importantly, these effects here are 0 and not negative, which means that we weren't just leading people who were going to open accounts at the treatment branches anyway to do it sooner than they would have. We're causing people who wouldn't have opened it otherwise to open accounts. And we can tell that because this is after the incentive goes away, we see 0 difference instead of a negative difference. Next, I'm going to move into the results on deposits, where we saw there was that average increase of about 14% in the number of deposits. Here I'm showing you the effect within each individual month. Here we again see prior to the treatment, no difference between the treatment and control branches. Then once we announce the lotteries, we see the difference between treatment and control jump up. But again, in that first month, it's not statistically significant from 0. And then in the second month, we do see this significant effect on the number of deposits. More deposits are happening at treatment branches than at control branches. And another interesting thing we see here is that this effect does persist over time. So after we remove the lottery, those people who were incentivized to open accounts at treatment branches continue to make more deposits every month, or there's a higher number of total deposits at the treatment branches than at the control branches. And if you break that down into people who opened accounts during the lottery months versus people who already had accounts, you see that that effect is entirely concentrated among people who were opening accounts during the lottery months. So they were nudged to open an account due to this additional incentive of PrizeLinked Savings, but they don't just use it for those 2 months and then stop using it once there are not lotteries anymore. They continue to make deposits, and so we see an increase in the total number of deposits at treatment branches that continues. It's declining over time, but it continues until about mid to late 2013. So that's about 3 years after the lottery incentive. And of course, this is one of the relevant things for implementers who are thinking not only about people's savings, but also about their bottom line. How much would a temporary incentive like this, what's its cost effectiveness, for how long are we going to see increases down the road in terms of deposits and savings at our branch? We can also look at use over time by looking at what fraction of users what fraction of clients in treatment and control branches make different numbers of deposits. So this is showing you on the vertical axis the proportion of accounts that made a certain number of transactions over the course of a year. So what you can see is in that, again, the lotteries happened late 2010. In that first year after the lotteries, we see about 20% of people are making 20 transactions or more. Then there are some making a middle number of transactions, and some, about 20% again, in the year after the lotteries are already not making any transactions in their accounts. But also importantly here, you don't see a difference between treatment and control. And these results are at the account level. So that's telling us that the people who were induced to open accounts by the lotteries are using them at similar rates as the people who would have opened them anyway in control branches. We can see that use is going down over time because we see these bars shifting more to the left in each subsequent year. So by 2014, there's a higher fraction of people who are making 0 transactions over the entire year. There's still a group here, about 15% of people in the treatment branches who are making 20 or more transactions. So they're still using the account at high rates. Finally, we can move to the savings results. So for that, I'm first going to show you results again from the individual account level, where we compare savings at accounts opened in the treatment branches during the lottery months to accounts opened in the control branches also during the lottery months. And what we see here is, again, the difference between those two treatment accounts relative to control accounts. What you can see is that maybe for the first couple of months after the lotteries in December 2010, here you see a negative difference, which means that maybe the treatment accounts are saving less, but these are, and these are kind of large magnitudes, but we can't distinguish them from 0 because the data are noisy here. What we do see though is at least by the 3rd month, they've caught up, and the accounts that were opened during the lottery months in treatment branches are saving at the same rates as those in control branches. So these new account openers that were nudged by the lottery are saving at the same rates as those who would have opened accounts anyway at control branches. Next, we can also look at how use of the accounts to save changes over time. Here, what I'm showing you is people who even have a small amount of money in the account, a small amount of savings. We set that threshold at 50 pesos, which is about $4 at the time. And here what you can see is in that first month after the lotteries, you see some people start to already stop using their account, but that happens both in treatment and control branches. And that happens if you're looking at administrative data from any bank. Over time, you're going to see the accounts, some fraction of the accounts stop being used. What's interesting here is that first, we don't see a difference between the rates of use in treatment and control accounts. So accounts that were opened in the treatment branches during the lottery months, their kind of survival rate over time in terms of people still using them to save is similar to the survival rate over time of accounts that were opened in the control branches during the lottery months. And we also see that over this 5-year period, well, the use of these accounts to save does fall. It's still around 40% after 5 years. So there is a fraction of these people, likely some of them induced to open accounts because of the lottery, who are continuing to use them to save over a 5-year period. Finally, I want to compare these results to a number of other randomized control trials that we've seen that look at various savings interventions. And I want to look at how kind of use of these accounts compares to in those other studies. And what we can learn from that comparison is, are these people who were induced to open an account by the lotteries, are they just using the accounts way less than people in other contexts that have seen other incentives to open accounts? Are they using them more? And here what we can see is the blue dots in the graph are telling us the total number of deposits, which we annualize so that we can compare across studies. So this is telling you the number of deposits per year that people are making over time. And here we can see that that's decreasing over time, which is consistent across all the studies that have multiple points in time to look at. But there's still continual use even 5 years later. And what we can see is that this is for people who opened accounts in the treatment branches during the lottery months. we can see that they're using the accounts at comparable rates to other studies in the literature, and actually at slightly higher rates than the majority of studies in the literature, but at lower rates than some others. The important thing to take away here is that they're not using them way less. It wasn't that we were inducing people to open accounts who were just going to end up not using the accounts at all. We're still seeing fairly comparable rates of use by these people who were incentivized to open the PrizeLinked savings accounts due to the lottery. So now let me draw a couple of conclusions to wrap up. First, to summarize the findings, what we found was that offering PrizeLinked savings products led branches to experience an increase in the number of accounts opened, the number of deposits at the branch, and the total amount saved at the branch. And this last result on the total amount saved, as well as the result on the number of deposits, was due to the new accounts being opened. We didn't find any increase in the amount saved or number of deposits for existing clients who were also eligible for this extra incentive due to the PrizeLinked savings. These new account openers, nudged by PrizeLinked savings, they do save in their accounts and they use the accounts at the same rates as normal account openers who open accounts anyway in control branches. And finally, on cost effectiveness, we can calculate what would be the equivalent annual interest rate of these lottery payments, and we calculate that that's about a 2.4% annual interest rate, which tells us that this is probably a cost-effective policy because other studies in developing countries that have offered interest rates around 3 to 5%, but offering them as just normal interest rates, every account earns 3 to 5% rather than a lottery, those studies have not found an effect either on account opening or on savings. And finally, an important question here is whether PrizeLinked savings can be seen as a gateway to financial inclusion. To speak to that, we were able to obtain data from Mexico's central bank, where we can link the accounts in our data from Bansefi and see whether those account holders have accounts at any other bank. And so when we do that, we find that these new account openers were previously unbanked. Using that central bank data, we find that 96% of them had no other bank account prior to opening this PrizeLinked savings account. And this, well, it may be surprising, for example, thinking in the US context where most people in the country have bank accounts, although there's still some unbanked, is less surprising in a developing country context. We find, or from a survey, we know in Mexico that of households that have at least one bank account, only 13% of those households have more than one bank account. So it's just not common for households to have more than one bank account, so they're not trying to optimize and say, oh, I'm gonna open a second account now that I've seen this PrizeLinked savings offer. Now, another natural question for financial inclusion is whether the increased savings we see in these branches that offer PrizeLinked savings, whether that's an increase in total savings or whether people just took money that they had elsewhere. We know it wasn't from other bank accounts, but maybe they took money from under the mattress. We don't have survey data in this study to look at that, but in another study that with the same bank where we do have survey data, we find that that's looking at a different intervention, but in that paper, we find that the increase in bank account savings that we see represents an increase in total savings. So we think it's likely that the increase here as well is an increase in total savings, but we can't say for sure. And then finally, we saw some people closing their accounts or no longer using and saving in their accounts over time. That happened in both treatment and control, but it's natural to ask whether these people induced to open accounts due to PrizeLinked savings open another account once they stop using their account with Bansefi, which would really show that this could be a gateway to financial inclusion. What we find there is that about 15% of account openers at the treatment branches do open an account at another bank over the next 3 years. Thank you.
Great. Thank you both for these talks. Both of them were really compelling pieces of evidence on how PrizeLinked incentives affect consumer behavior. What we're going to do next is we're going to jump into a discussion with Rebecca Rouse, the director of IPA's Financial Inclusion Program. Rebecca will describe a few of her takeaways from the studies, and then we'll discuss what lessons financial service providers should take from this research with Jeremy and Sean. Rebecca, handing off to you now.
Great, everyone can see me. Hi, good morning or good afternoon at this point. And just to start out, thank you, Sean and Jeremy, for these presentations. It was really great to see these two studies side by side and be able to compare pretty similar findings or related findings. And also thanks to everyone who's logged into the webinar right now. I know there's so many financial inclusion events happening this week, and so we really appreciate you taking the time to join us. So I just have two kind of quick takeaways, and I'm going to cheat a little because part of this I'd like to throw back to Sean and Jeremy for the reactions. The first is around what we should do with this knowledge now, or kind of where this fits in our work to promote savings and debt reduction. And then the second is more around that consumer protection angle and the driver, why we think lotteries are successful, what drives that, and then where does that kind of play out in other contexts where we might need to look at consumer protection. So back to the what should we do with this information, so what are our implications here? Our goal at IPA, with all of the work that we do, is really to help institutions understand better whether or not the money that they're investing in their approaches is actually worth the outcome that they're getting, right? So what's the bang for your buck here? And Sean mentioned that in his presentation as well. Doing something like this costs money in terms of paying for marketing, paying for the prizes themselves, all that stuff. And I think these two studies really show the importance of trying out these types of approaches as part of a greater evaluation or learning agenda for an institution, right? Because we've seen that lotteries are popular, these PrizeLinked products are popular, and so if you're just looking at outcomes of folks who are taking up the PrizeLinked options, you're thinking, great, this is doing really well. And without having that comparison group, or without incorporating a learning plan into the implementation, you really wouldn't be able to understand what the actual return on investment is for your intervention, right? So I think my main takeaway, rather than kind of being disappointed in some of the results here, or saying like, hey, this is we got to throw this out, or this isn't the right approach, or there's nothing here for me to apply, or what should I do with these results if it's kind of effective for account openings but maybe not creating long-term behavior change. I think my response to those questions would be just that testing matters, right? So as institutions are designing approaches or thinking about what sort of behaviorally informed interventions they can incorporate into their work, my biggest takeaway here is that the learning plan is so important, right? So understanding what your learning objectives are from the get-go, understanding what your business objectives are, where are you, what's it going to take for you to break even on offering a savings account for for low-income savers? What's it going to take for an investment in some kind of nudge for debt repayments to actually be worth the amount of money that you're paying for that nudge, right? So first, what are you trying to achieve, and really having a clear definition of that, and then laying out all of the assumptions that you have about why your proposed intervention is going to move the needle on what you want to achieve, right? So in this case, we talked a lot about behavioral biases and stuff that Michael presented at the beginning of the webinar. Are the barriers to achieving your goal, are they actually behavioral? What are we actually seeing in the way that clients are behaving now, or where do we think we can apply a nudge? And is that actually solving for a behavioral problem, or is there something else, right, that can't be solved by a nudge? That would be my first question, right? And then, are we applying the right types of nudges? Are we addressing the right potential barriers to behavior change? So all of that needs to be implemented as part of a long-term learning agenda for your institution. Are you collecting the right data? How are you going to know whether or not things are working? Do you have data in-house that you can be using to monitor outcomes? Obviously we can look at things like account openings, deposits or payments received and things like that. Are there assumptions that we should be testing here, and how do we do that? Are there places where we can incorporate randomized design, comparison groups, into the rollout of whatever you're testing to really get at the true impact of that nudge that you're adding, right? It's not cost effective, obviously, for most financial institutions to do long-term studies like the, tracking outcomes 3 years down the line, like Sean was able to do, but what can we then learn from those types of studies, and what kinds of tools or lessons can we take from those so we don't have to reinvent the wheel and do the same thing every time, right? These are questions that I think institutions should be asking when they're trying to decide whether or not the investment or the effort is worth the outcome. So just wanted to quickly mention, I don't think I have too much time, and I want to make sure that we get to Q&A from the audience, but I want to quickly mention 2 other studies that IPA has done in the last couple of years, which kind of get at that question of cost effectiveness of nudges to combat present bias, which is the bias that we're focused on for these prize-linked interventions. So the first is automation and defaults. So this is something that is much easier to do with digital products. How can we automate behaviors if maybe, the place that people were falling off on some of these long-term savings behaviors were just, it's a pain to go and make a deposit, to physically go, right, or to remember to go. There's some kind of barrier that's keeping me from sustaining that long-term savings behavior over time. So maybe the solution to that could be an automated savings transfer, right? So we can do the work for the people that they've already stated that they have a desire to save. Maybe we can build features into products that will actually take that step, right? So the example that I want to give is a study from Afghanistan. Very different environment from the U.S., but at the same time, it's testing out some mechanisms that were pioneered in the U.S. with 401k contributions and employer-based retirement savings. So this is a study by Josh Blumenstock, Michael Collin, and Tarek Ghani, where they tested out automated 5% savings contributions, which were automatically taken from people's paychecks and deposited into a savings account as a default. People had the chance to change the default, say, oh no, I don't want those deposits to be made every time I get paid, but the majority of folks actually stayed in. So long story short, in this case, people who were assigned a default contribution rate, savings rate of 5% of their paycheck were 40 percentage points more likely to contribute to their savings account 6 months later than people who had a default contribution of 0. And looking at cost effectiveness, this was compared to a separate incentive where the employer was just going to match savings to a certain amount. So the defaults were as effective as a 50% match on savings. And so I think that's important. And again, kind of showing how using this experimental approach and comparing different approaches as part of a learning agenda for an institution can get you at the most cost-effective solution to drive the behavior that you want to see. My second example, just quickly, is from Colombia, a project with Colpensiones, a public benefits provider in Colombia that we did with the Inter-American Development Bank. Here, we're also looking to drive savings behaviors. This is a really long-term savings plan, right? Very long time horizon on retirement savings. We were targeting informal sector employees. So folks who did not have the benefit of having an employer who could, default a contribution or automatically transfer money when they got paid. So here we also want to make sure that people are paying attention to the need to save. They are not procrastinating. They're keeping it top of mind, and they're thinking about the future versus the present. So we tested out using text messages. So just texting people to remind them to make their savings contribution. And again, we found that text messages were effective at increasing savings among people who were already actively saving before they got the messages, not effective for activating new savers. But going back to that cost effectiveness question, for every $1 spent on text messages to active savers, after 10 months of messaging, $1 investment led to $17.36 of savings generated. So again, a great example of the way that, in this case, rapid fire testing and using comparison groups allowed Colpensiones to get down to the most cost-effective approach to keeping active savers more active, right? So in comparison, they've got, after 10 months of messaging, they were able to get a return of $17.36 for every $1 spent, 15 months out, that dropped to $15.87 of new savings per dollar spent. So they really did find that sweet spot. After 10 months, wasn't worth doing more. They were actually going to, do worse. So, I really like these examples as ways of saying, well, hey, there's no perfect solution here. It's not like any of these studies are coming back and saying like, yes, this is the approach. It's going to increase savings or increase repayment rates for everybody. But really, it's about testing, documenting what you're testing, understanding your objectives, understanding the assumptions that you're making about why you think your approach might or might not work, and testing those. And then tracking results to see, and how much, and cost, obviously, and cost effectiveness, to find the right approach that's going to get the right target segment that you want to move in impact for. It's going to cost, the investment's going to be worth the outcome, essentially. So it really is a question of continuing to fine tune, continuing to test, and continuing to incorporate learning into everything that you're doing, rather than there being a one-size-fits-all approach to this. So that's just my quick reactions to these studies. I guess maybe to start a conversation here, I want to throw a question back to Sean and Jeremy. So thinking about why we think the lotteries approach was attractive, there's a couple of things, right? So gambling is exciting. People tend to be overly optimistic about their chance of winning, so they think that it's more likely that they'll win. They're more optimistic about that, but maybe not as optimistic, or they put insufficient weight on the likelihood that a bad thing would happen, right? So, everybody's overly optimistic about the good things, but maybe less, kind of believe less in the probability of something bad happening, even if that thing is more likely to happen, right? So I'm thinking about, what are the implications for this attitude to products like insurance? What can insurance providers take away from this? We know that take up and usage of insurance products is low across the board. Often people think they might not need that. They might not need to make that investment today to cover a risk in the future, because it's really not, I'm healthy right now. It's probably not going to be, something happening to me down the line, because right now in this moment I feel good, I'm healthy. So, what are some of the implications of this work and research on this behavioral tendency that could inform the marketing and development of insurance products? And then, I guess linked to that also, we are trying to exploit that bias for good, because we want to help consumers do better in their financial plans. But what happens when people are trying to exploit that bias for something a little bit more malicious? And so thinking about that consumer protection angle, where are there places where we might think that regulation might need to step in to protect consumers? And I was just thinking of, where that might happen. So things like, thinking about digital finance and implications, what about things like data sharing, data privacy, consumer willingness to sign away, rights to their own personal data, or let others use their data, having limited understanding of potential harm, or thinking that maybe something bad won't happen if they just sign this off because they want to get a benefit today. Things like not anticipating future negative events, selecting into credit products that might not be a good fit, variable interest rates, and not anticipating things down the line that could happen there. I'd love to hear Sean and Jeremy's thoughts just about where we might need to take a consumer protection approach to dealing with this bias. Thanks.
Well, great. Thanks, Rebecca. Perhaps I can jump in for a couple of thoughts. On insurance, I think the answer is we're at the really early stages of any research on the effectiveness of lottery-like incentives and improving financial behavior. So we can imagine that there may be similar motivations to nudge people into insurance products that Sean saw in his formal savings products, that by giving people a little bit of an incentive to get started at the outset may help with uptake of insurance. But I'm not aware of any evidence that documents this, so I think it's worth testing. And then I'll just jump in with a quick thought on the second question about financial exploitation or protection or regulation. I think one important point from both my study and Sean's study is that neither one of us found any negative effects on consumers from the introduction of these incentives. So to the extent that we think about regulation, we don't find any evidence, or at least I don't find any evidence, that there's any reason why these types of products should be regulated out of existence. And we may want to create a space for financial providers to perhaps use these in different ways. You know, there may be different ways to structure these things to get better outcomes. And given we see no negative effects, there doesn't seem to be a strong call to prevent financial institutions from providing incentives like these. You know, regulation should not prevent that from happening, in my view.
Yeah, let me first echo Jeremy's comment that we, from the consumer protection angle, thinking about PrizeLinked Savings in particular, we weren't seeing any sort of the negative effects that from a regulatory perspective you might, you know, would raise a red flag and potentially justify some of the states, for example, keeping PrizeLinked Savings products illegal. We don't see any negative effects. So from a consumer welfare perspective, it doesn't seem like there's a reason for states not to allow these products to exist. And then thinking more broadly about consumer financial protection, this is an area that I'm super interested in, and in partnering with different government agencies such as financial regulators, as well as with different financial institutions to do more of these kind of tests that Rebecca was talking about, and learn more on the impacts of consumer financial protection. Rebecca, you mentioned in particular the digital finance space. We've seen digital finance growing both in the US as well as across the world, a lot in Africa, where you now can easily, you know, go on your phone and get a loan without a credit history, which can be transformational for people who didn't have access to formal credit markets beforehand, because they didn't have, it can potentially be transformational for people who didn't have access to credit markets beforehand, but it can also harm consumers for the reasons you mentioned of, you know, maybe now you can go quickly get a loan, and so you're able to become over indebted, and because of some behavioral bias, maybe not take into account the full amount of debt you're taking on from the various loans. So on that, I should plug also a couple of initiatives. First, at SIGA at UC Berkeley, they have a digital credit observatory initiative funded by the Gates Foundation, where they're asking a lot of those questions in the digital finance space in particular. So for example, a study by Alfredo Berlando and co-authors is looking at what is the effect for consumer welfare if we create a little delay in the process. So rather than allowing people to kind of take out a digital credit loan right away, what if we put a little wait period in there where they have to ask for the loan today and then not get it until a little further down the road, which takes out that kind of potential impulse and present bias of just being able to take out the loan right now and then ending up over indebted. So they're trying to look at whether that can improve consumer welfare. And so that's a potential regulation that if they find that I'm not familiar with whether they have results yet, but if they find that it does benefit consumers, then that's something that regulators could think about implementing. And then more broadly, with consumer protection overall, I'm thinking about a few other projects as well outside of digital finance, just about overall, you know, do consumers have access to information, for example, about what loan rates they could get if they shopped across different banks. So I'm working on a project with Chile's financial regulator and trying to do something similar with IPA and other financial regulators in Latin America to see whether, for example, providing consumers with an interactive tool that allows them to see for a consumer with similar characteristics to them who's searching for a certain type of loan, what were the prices that people got from different banks, which would allow people, since it's kind of can be costly to go to different banks and get price quotes, that would allow people to potentially better search across banks and get better loan terms down the road.
Great, thank you both for the rich discussion. Before we end, we've received a number of questions from the audience. I think it might make sense to start at the most micro level and really think about these prize-linked products. In terms of the structure of the incentive, do both of you have any insight on how the incentive should be structured to maximize consumer engagement if a prize-linked product were appropriate?
Yeah, thanks, Michael. So in the randomized controlled trial, we were only able to test one prize structure, so we only have hard evidence on the way the particular incentives were structured in that study. But before we ran the RCT, we did some pilot work with another financial institution and asked consumers, what type of incentive structure they think might be most effective or most incentivizing to them. And we found overwhelmingly the responses were that people wanted a large number of small dollar prizes coupled with one or two large life-changing prizes at the end, life-changing grand prizes, which was the structure that we tried to adopt in our study. But there's a lot of place for research on whether different prize structures might be more effective in terms of motivating behavior change. So, one thing to echo again is we didn't see any negative effects. So there's little reason to suggest that trying different things may not be, maybe actually be a good thing. And since we've only taken really the first couple bites of the apple at designing prize structures to motivate behavior change, there's probably a large scope to try different ways of structuring these incentives to improve behavior change.
Yeah, in the case of our study, we only tested one structure to the product, which was based on what they found in Jeremy's study when they just asked people. Seems like it is what people wanted, which was we had 2 large prizes and a lot of small prizes. But it would be, I think, worthwhile for financial institutions to do these tests and other experiments to see whether a different structure is more cost effective. For example, maybe we thought before I heard what the clients in Jeremy's study told them directly, we thought that maybe you could get rid of all the small prizes. Since there were so many of them in our study, they ended up being the bulk of the cost. So potentially, if it really is just this small chance at a large prize that's driving the incentive, then you could test getting rid of the small prizes and it could be much more cost effective. On the other hand, maybe people do really like the small prizes too, and maybe you could get rid of the large prizes, or based on what Jeremy reported from his study, maybe you could, if you were to do this over a year rather than 2 months, maybe you don't need the large prizes every 2 months. Maybe you just need one big prize at the end of the year. And those are all things that I think in neither of our studies we tested, because you need, a large enough sample size to be able to test these different structures. But I think that's definitely an avenue that could be future research and future tests between that financial institutions could implement.
Great, that's really interesting. And it's good to hear that we're aligned here. We also received a question about how to interpret both of these studies together. The participant who asked the question understood these incentives as bringing someone to the door of the financial institution, but was wondering if there were existing frictions in the actual product design that may have inhibited the success of any sort of incentive, whether it's prize linked or just a monetary incentive. Sean, do you want to start with that?
Sure. Yeah. So yeah, in our study we saw, or actually, let me first say in how they connect together. I think one thing that was consistent across the 2 studies is that we saw that people who already were clients of the financial institution, neither the prize-linked debt reduction incentive nor the prize-linked savings incentive had any effect on them. So that's a potentially important thing for implementers to know as well. This could be a type of incentive that's more valuable for what you mentioned, Michael, of bringing people to the door rather than increasing the savings or debt reduction of your existing clients. And that's certainly what our study suggests. On your second question, I think, yeah, other barriers to financial inclusion are definitely important, and some of those could still exist once the client is kind of at the door based on the incentive. You could think about, for example, if there were a cost of opening the account, if there were a minimum balance in the account, if the person actually doesn't live that close to the bank, those could all be things that would prevent the incentive from having as much impact as it could. And I think those are all things that we have had some randomized control trials to test the impacts of reducing various of those barriers. In our study in particular, this was a government created social bank, and they don't have any account fees or minimum balance requirements. And so those 2 potential barriers are out of the picture. It could still be someone who doesn't live that close to the bank, but happened to see the sign when they were close to the bank one day. And so for them, there could still be a kind of distance transaction cost barrier, even though there aren't any direct fees from the bank. And I have some other research looking at that among cash transfer recipients in Mexico who received accounts and debit cards from this bank. And there we find that distance is a substantial barrier to financial inclusion. People who live further from the bank end up benefiting less from getting an account automatically and a debit card because it's still costly for them to go to the bank when they want to access their savings.
Jeremy, do you have any thoughts on frictions within the financial service providers that could inhibit usage over and above incentives?
Yeah, so I'll turn it back a little bit to something Rebecca touched on in her discussion. So there can be frictions on the success of behavioral interventions as well, right? So if someone loses their job or experiences some large negative financial shock, there's an incentive structure or a smartly designed nudge is going to have little effect on them. So in our context, right, if someone loses a job or loses a source of income, they're not going to be able to repay their debts no matter what sort of structure we implement. We did a lot of discussion with the provider and looking at exit interviews, people that drop out of the program, and suggest that these people exist. Of course, people lose their jobs and can't repay their debts, but a lot of the drop within the context of the program is people who appeared to just not want to stick with the onerous repayment terms month over month. They wanted to handle things on their own, and often people handle things on their own with these large debt burdens that leads to bankruptcy. So it didn't appear like that was going to be a major impediment in the context of the effectiveness in our study, but it is something important to think about when setting up any study for any financial provider of where exactly the pain point is, or what's really driving these negative effects, and make sure that you try to align your program or your intervention to target changeable dimensions of behavior, and recognize that not all behaviors can be changed through behavioral type interventions.
Great, thank you very much. I think we have time for one more question, so I apologize if we didn't get to the question you asked. We've certainly had more than we have time to answer. This question is around what next steps financial service providers should think about that. Are there any immediate questions that come out of this study around PrizeLinked incentives or other types of incentives, or I'll even throw in behavioral biases that would make sense to start think about testing? Jeremy, why don't you start?
Okay. Yeah, I think my main takeaway and push is always that there should be more testing and more partnerships between institutions and researchers to really figure out what works best. So I'm interested to talk with anyone on the webinar who's interested in more rigorous evidence on ways to improve financial health, particularly through behavioral interventions. I think there's a really large space to conduct more research, particularly on the debt side, in comparison to the number of interventions we've tried. On the savings side, there's really much less evidence on what's effective in helping consumers reduce their debts. So I have a number of interventions in the field, testing things like smart reframing debt repayments in terms of small but increasing series of milestones to try to capture some psychological quick wins, and then things like behaviorally informed reminder messages and interventions to more closely align income receipt with debt repayment to try to prevent things like mental juggling and temptation in the interim, and things like partitioning accounts specifically for debt repayment purposes to see if those have any effects. But the scope of what we can test is really enormous. And so, just forming these partnerships to conduct more trials and build more evidence about what's effective is really, I think, in everyone's interest. And so something I'm particularly interested in doing.
Yeah, I think there's definitely a lot more research to be done, and I echo Jeremy's interest in working with potential financial institutions that are interested in testing various interventions or incentives that could be implemented to help, for example, help people overcome behavioral biases and increase their savings or increase their debt reduction. I think a lot of times figuring out the exact study design of the types of studies that we presented happens through more of a conversation with the implementing partner. So it's not that we come in saying like, oh, I think this X behavioral bias is really important and we don't have anything on that and we should do this exact intervention. But instead it's, sitting down, the financial institution will often say, oh, we have this problem, we're struggling to get customers here, people aren't saving once they open accounts, or they're not meeting their debt reduction plans, we have high dropout rates. And it's really more of a discussion where we try to, gain some qualitative information from them. What have they already gathered from, maybe they've already done some focus groups with clients, and then it's kind of more of a discussion figuring out what's important to the financial institution, what they think, will help their customers, what barriers they've been experiencing, and then we kind of design research that can address how to overcome those barriers. On the topic in particular about kind of other studies on behavioral biases, I also wanted to mention a study I'm working on with a financial technology company in Mexico. This company provides a payments technology, so kind of a fintech payments technology, and we're looking at the question of why small vendors don't adopt profitable technologies through offering the existing clients of this fintech provider a lower fee, which is a profitable technology for them because we're just lowering their costs. And we're testing various behavioral biases that could interact to lead to low rates of adoption. So present bias, which we talked about here in the context of PrizeLinked Savings, but that could interact with other biases that lead to even lower rates of adoption. For example, limited memory. People, maybe they're present bias, but they plan to procrastinate. You could solve that by giving them a deadline. If they're present bias, they'll adopt at the deadline, even if they procrastinate. But then if they're also forgetful, maybe they forget by the deadline. So that drives down adoption. And then you could also potentially be overconfident about your memory. So maybe you think you're going to remember, but then you don't end up remembering. So that also drives down adoption. And in this study in Mexico, we've designed an experiment that allows us to separately identify what's the effect of each of those three potential biases, and then do they interact with each other to further drive down adoption of profitable technologies.
All of those sound like really exciting topics. I want to thank everybody for spending the time to listen today, as well as our panelists for taking the time to present their work and also discuss the results so thoughtfully. As a reminder, we'll be sending out an email with a link to the recording to all the people who registered, as well as posting on the IPA site. So thank you again and have a really good day.